All right, so then again, we have this big red candle and these consolidation candles. And that's telling me that probability is still favoring downside on gold. And again, we should be headed back to about the 2550 level. I'm even thinking there is a chance we could go even below 2500 into year end or early 2025. Gold is just pulling back and working off an overbought scenario. And so I think I want everyone to understand is that while short term, there may be some weakness in gold, I think it still has a lot of upside to come in the coming year or 2 years, easily 3,000 an ounce. Taking this low and stretching it up to this high here. As you can see right through the high of 2011 from this low here, that would give us a possibility as well, which again starts to take these trend lines much, much higher into the 4,000 and 5,000 range.
Gold prices fell 0.85% on Thursday, trading at $2,626 as investors digested the latest U.S. jobless claims data ahead of November's Nonfarm Payrolls report. The decline was driven by a rise in US Treasury bond yields, which reduced the appeal of the non-yielding metal. On Wednesday, gold remained relatively stable, fluctuating within a narrow range between resistance at $2,663.51 and $2,693.40 and support levels at $2,629.13 to $2,607.35. This movement reflected market indecision, with prices staying below the key 50-day moving average of $2,668.65, highlighting the absence of a clear directional trend. Market analyst Gareth Soloway views gold's recent weakness as part of a broader technical correction in an overbought market. He predicts a potential decline to $2,550 or lower in early 2025. However, he emphasizes that this pullback does not alter the long-term bullish outlook for gold. Soloway points to longer-term logarithmic trend lines, suggesting the possibility of gold reaching $4,000 to $5,000 an ounce in the years ahead. While these projections are not immediate, they reinforce the metal's appeal as a valuable long-term investment. Macroeconomic factors also continue to play a significant role in gold's performance. Federal Reserve Chair Jerome Powell recently highlighted the resilience of the U.S. economy, dampening expectations for aggressive rate cuts. Despite this, the CME Group's FedWatch tool indicates a 74% probability of a 25 basis point rate cut at the Fed's December meeting. Lower interest rates have historically supported gold prices by increasing their relative attractiveness compared to yield-bearing assets. Gold's trajectory reflects the ongoing interplay of technical adjustments and macroeconomic dynamics. While short-term volatility may persist, the broader outlook remains optimistic, with analysts expecting prices to rebound to $3,000 an ounce within the next 2 years. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So gold's been very interesting because, we've seen this meteoric rise in 2024, and then towards the end of 2024, we're seeing a little bit of weakness creep in. Part of that is being overbought, and then the other side is there's really been a risk on push, which is usually not a positive for gold, right? Gold is always that safety hedge. And so as we see, Donald Trump talking about deregulation and all these things that are positive for growth stocks, a lot of money is probably being pulled out of gold to go into growth stocks. And let's not forget, Bitcoin has also made a big move up. And I think that's taken a little bit of the money flow away from gold as well. So if we take a look at the chart here of gold, let's get right into it. What we can see is the beauty of this is that gold has been behaving on a technical basis exactly how you would expect, right? So here going back to March, we started to get into this kind of parallel channel sloping up. You can see we came up to the high end here, which matches this high perfectly. And then we can see here the lows, low here, right through here and there. And so ultimately notice how once we tagged that high, we got the big pullback. It took us back to this low here, which also happened to be a secondary technical trend line of support. And then we got that bounce. And then we've seen these bigger sell candles come in. And one of the things on a technical basis we want to be aware of is that when you're heading in an uptrend, notice how over here, most of the big candles were green, right? Green. I mean, there's a couple bigger reds, but for the most part, these are bigger greens with small pullback red candles. Notice how once we made the high, big red, small, small, small green, big red, and even even though this is a decent sized candle, it's still nothing compared to this. And that tells us that the trend in the short term has changed here. All right. So then again, we have this big red candle and these consolidation candles. And that's telling me that probability is still favoring downside on gold. And again, we should be headed back to about the 2550 level. I'm even thinking there is a chance we could go even below 2500 into year end or early 2025. But this is the kicker, right? Is that gold is just pulling back and working off an overbought scenario. And so I think I want everyone to understand is that while short term, there may be some weakness in gold, I think it still has a lot of upside to come in the coming year or 2 years, easily 3,000 an ounce. So what we'll do is let's go take a look at that chart. And what we're going to do is go look at a larger time frame. So when you're looking out a ways and you want to see, okay, well, where could gold go in 2025 or maybe 2026? What we want to do is we want to look at this parallel here, right? So let's clean it up a little bit. What we know is that shorter term, once we get that bullish move, this trend line here will work as resistance. Now, we just don't know where that will be, but we do see that it is sloping up. And again, even if we went up right now, it would be near 2,900 in the short term. So that would give us one price target. Probably by the time it gets up there, I'm guessing it's around 3,000, that key even number. And then what we'd also want to do is just kind of scan out here. And this is where it gets more fun for me as an investor and saying, okay, well, if we look at the logarithmic chart, right, and we go back a ways, what kind of trend lines are showing up on a longer scale? And you can do things like taking this low and stretching it up to this high here. And so you can see right through the high of 2011 from this low here. That would give us a possibility as well, which again starts to take these trend lines much, much higher into the 4,000 and 5,000 range.
The silver market shows upward pressure, with the $31.50 level emerging as a key resistance point. This barrier has been challenging to break, but the current momentum suggests the potential for a breakout. Should silver surge beyond this level, it could trigger a wave of buying interest fueled by fear of missing out. While silver's precious metal status often ties it to gold, its industrial applications add another layer of complexity to its market behavior. This dual role means silver's performance is also influenced by broader economic factors, such as the upcoming Nonfarm Payrolls report, which could impact industrial demand expectations. Despite recent signs of strength, market analyst Gareth Soloway cautions that silver has experienced sharper percentage declines than gold and remains vulnerable to bearish technical patterns. He projects a potential dip to $28 per ounce in the near term, driven by economic uncertainties and recession risks. However, silver's long-term outlook remains positive, with inflationary pressures likely to bolster prices over time. Let's get back to the interview.
Yeah, so silver's been a tricky one, right? I mean, it's definitely lagged gold. There's no doubt about it. As we've seen gold pull back, silver has also pulled back percentage-wise much more, which is normal for silver. Now, a couple things I'm following here. We're kind of stuck in this area. Here's a little resistance trend line. You can see we broke below it, and then it hit, and then has come back down. And then you have this lower trend line right here that is working as support. This low here, and then this low, and this low. Now, one of the things I'm watching here is a bearish formation that likely tells us silver will break down in the near term. Downside target, you can see this beautiful kind of trend line from these tops. This gives me a downside target of basically $28 an ounce. So what I'm expecting here in the next month or two is silver to chop, then eventually break down and flush to about $28 an ounce. And then once we get into that level, I think that's where you start to nibble a little bit more on the silver trade, looking for that next big move to the upside. And again, just to be clear, the reason why silver is trickier to gauge is because it has that industrial side. And to me, it's become more and more of an industrial metal over time versus gold, which has just been that store of safety. But again, silver, much, much more industrial. So if we do head towards a recession, you would assume silver would underperform. Eventually, that inflation aspect that I think comes back will help silver. But in the shorter term, it's a little bit more murky. And again, for me, it's the risk that if we go to 107 on Bitcoin, let's say, we could pull back to 75 next year. Again, I don't know where we'll be at the end of the year, but that drawdown is a hefty drawdown of 30% or so at that point. And then if we look at the stock market is honestly even more concerning to me than Bitcoin up at these levels after this big run. The stock market, the valuations, the metrics, the Buffett rule. I mean, all of these indicators are flashing extreme, not just a quick dip like we saw in August where we dropped, 15, 10% really quickly, but I think a more sustained bear market. And I think it's going to come when we see a recession. And this is the kicker. A recession is okay if the Fed can cut rates to zero like they did after COVID, or, then we can do it, right? Then the market's like, yay, we're getting cheap or free money. But my thesis for 2025 is that inflation will still be slightly elevated and the Fed will not be able to use its tools like usual to get us out of that recession, which means further downside in equity prices.
The interplay between technical corrections and macroeconomic influences continues to shape the outlook for gold and silver. While both metals face short-term challenges, including resistance levels and economic uncertainties, their long-term potential remains robust. Silver's dual role as a precious and industrial metal adds unique complexity, while gold's historical stability underscores its value during economic shifts. Investors may find these trends compelling reasons to hold strategic, long-term positions in both metals despite near-term volatility. What factors will have the most significant impact on gold and silver prices in the coming year? Share your insights below. Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.